At its peak, China's HNA group presided over an estimated $170 billion of assets across the world. The conglomerate was a big shareholder in Deutsche Bank and Hilton Hotels. They owned airports and other real estate in Germany, China, and the United States. And they had the third largest aircraft leasing business in the world, owning over 900 planes. Most amazing of all, HNA bought virtually all of this in just a few years. By the time the party ended in May 2017, the company was doing at least one multi-million or even billion-dollar transaction each month. And then, as fast as it came up, it all came crashing down. In this video, we're going to talk about one of the biggest and craziest implosions in corporate history. But first, let me talk about the Asianometry Patreon. Early access members get to watch new videos and see selected references for them before they're released to the public. It helps support the videos since views are so volatile. I appreciate every pledge. Thanks, and on with the show. Chinese companies are infamous for their murky early histories and opaque ownership structures. The southern Chinese island of Hainan is about as large as Taiwan, but has a much smaller population of about 9 million people. Until 1988, the island was a special administrative region within the Guangdong province. But in 1988, the central government made Hainan into its own province and designated it as a special economic zone to try and generate more investment. The new Hainan provincial government had a formidable task ahead of it. Much like Taiwan, Hainan was a historical backwater, a hotbed for bandits in the 1920s. How were they going to get people to come? That same year, the central Chinese government began deregulating its airline industry. It restructured its former national airline monopoly into 6 individual airlines across the country. Another measure of that was to allow private-public partnerships between provincial governments and private companies to allow these provinces to establish regional airline carriers of their own. So, the Hainan government contributed 10 million RMB of startup capital to start Hainan Provincial Airlines, but the company did nothing with it after that, never acquiring an airplane or even a civil license. Tan Feng was the son of Communist Party officials and served in the People's Liberation Army Air Force. After that, he worked in China's civil aviation regulator, the CAAC. There, he met a variety of people who would go on to also work at HNA Group, including co-founder Wang Jian. Chen then moved to China's National Air Regulations Bureau and won a scholarship to study air transportation logistics at a school in Germany. But when he came back, he found the bureau abolished, so he worked at the Agricultural Investment Trust of China and then the World Bank Loan Office in Haikou, Hainan's capital city. It is worth noting that the powerful Wang Zheshang, anti-corruption czar and Xi Jinping ally, served as the Agricultural Investment Trust of China's chief executive while Chen was there. Rumors exist of a deeper connection, of course, but there is nothing solid here. Wang was only there for a year after all. Anyway, while Chen was at the loan office, a former colleague of his from the civil aviation regulator then recruits him to manage this airline, at the time bogged down with little progress. 10 million RMB, or about $1.4 million, is nowhere near enough to run an airline or even buy a plane. Thusly, Chen and his colleague convinced the local government to reboot the business as a joint stock company. This relatively new development in China allowed private individuals to take share in this state-owned enterprise. In 1993, Hainan Provincial Airlines restructured as a corporation and was allowed to sell shares. The sales raised 250 million RMB, or about $35 million, from 122 stakeholders. That May, the airline began operations. In these early days, HNA established a dual-chairman structure. Co-founder and partner Wang Jian managed the company's internal affairs and strategic direction. He stayed much more in the shadows. Tan Feng, on the other hand, served as the company's external communications man. Much of the time, he was running around telling stories to banks and potential investors to raise money. $35 million sounds like a lot, and I certainly wouldn't mind having that in my pocket. But in the airline world, it is chump change. So Chen and his team went to the banks, which lent them another 600 million RMB, or $84 million. But on what collateral? In these early days, Chinese banks did not know much about how mortgages should work. Chen told the banks that the money would be used to buy a plane. A Western bank would then ask to have a claim on that plane, like how a residential mortgage is backed by a house. But the Chinese bank didn't do this. Rather, they assigned the plane's property rights to the borrower, HNA Group. This allowed HNA to turn around and remortgage the purchased plane again to another bank for even more money. Chinese banks eventually caught on, but HNA never failed to get creative in the way they borrowed money. One remortgaging tactic they used was to borrow against the future revenue streams from the plane's air routes. So, every plane was mortgaged twice, first as a hard asset backing a loan, second with its future revenue streams. How does that work? Not sure. Anyway, this one plane, two meal approach allowed HNA to double dip their leverage and grow very fast. Plain bank loan terms are very long-lived, 10 to 15 years, which gave HNA plenty of time to figure out how to pay back those loans. But you don't need me to tell you that it is a perilous way to scale a business. Many times, the only way to pay back that loan was to take out another loan down the line. In 1995, Chen flew to New York City and pitched hedge fund manager George Soros' Quantum Fund. There, he talked about Hainan's development prospects as well as the high market potential for airlines in China. Convinced, Soros invested $25 million. It was the first Chinese-American joint venture in the China aviation space. Chen later said that the investment and Soros' reputation helped boost the startup airline's image. When Hainan Airlines later listed on a Shanghai stock exchange, the Quantum Fund-owned vehicle, American Aviation LDC, was reported as its largest shareholder with 21%. In 2005, Soros doubled his investment to $50 million, using a share swap to acquire a 10% stake in an unlisted unit of HNA Group. Altogether, their ownership was said to be worth something like $110 million. The New York Times reported that the Quantum Fund sold its stake in 2011. One of the reasons why they did so was HNA's lack of corporate transparency and governance. The company is infamously complicated and opaque. At the IPO, co-founders Chen Feng and Wang Jian personally held a minuscule stake, Chen with 32,000 shares and Wang with 28,000, but the two controlled another shell company with enough shares to be the second largest shareholder. Since then, the group's ownership structure has shifted around but has always remained extremely murky. From 2002 to 2015, HNA Group's controlling shareholder was a Hainan Airlines trade union. Then it was replaced by a non-profit called the Hainan Zhihang Charity Foundation. HNA founded the charity in 2000 with a share donation worth 20 million RMB. The foundation is said to support anti-poverty efforts, but it does not seem to do much and employs a variety of company friends and family members. In all likelihood, it is a stealth vehicle through which Chen can control the company. Serving on a sham foundation was not the only way the co-founders' friends and family profited from HNA. Chen's little brother set up an American firm to buy engines and spare parts for the airline's fleet. And the airline hired Wang Jian's little brother, Wang Wei, to help build high-end oceanfront villas and a golf course at Haikou. These deals and others eventually made him a billionaire. In 1997, Hainan Provincial Airlines renamed itself to Hainan Airlines. A year later, it established Hainan HNA Holdings, the predecessor of what would eventually become HNA Group. By the late 1990s, China's airline situation was a bit messy. There were over 30 carriers in the country at the time, and they were all losing money. Some consolidation was required. In 2000, China's civil air regulator reorganized its state-owned aviation companies, creating an oligopoly of 3 airlines: Air China, China Eastern, and China Southern. By now, Hainan Airlines' fleet had grown to 31 airplanes, but that was nowhere near big enough to compete with the giants. So they arranged marriages with 3 other small airlines: China Xinhua Airlines, Chang'an Airlines, and Jiangxi Airlines. China Xinhua Airlines in particular was key in turning Hainan into a national flagship. Xinhua operated out of Beijing's 2 big airports, flying over 80 routes to over 50 cities across China. But Xinhua also struggled to make money, with debt ratios reaching as high as 98%. So in April 2001, they sold themselves to HNA Group for about a billion RMB, though most of that purchase price was not in cash, but real assets like planes. The new four-way entity focused on short and medium-range flights serving China's regional cities, outside of the major routes dominated by the state-owned airlines. This strategy succeeded, and the airlines in 2001 turned a profit. But HNA then flew headlong into the first SARS epidemic in 2003. The crisis struck the air and travel business pretty hard. HNA, already financially stretched because of its earlier acquisitions, turned a massive loss of 1.5 billion RMB. The company came close to bankruptcy. To survive, they turned to the Hainan provincial government, and the government, despite having a relatively small financial stake in the venture, bailed it out anyway. In 2005, the Hainan government injected 1.5 billion RMB, 10% of its entire revenue that year, essentially saving the airline. Thanks to its white beaches and tropical weather, Hainan gained a reputation as a vacation destination. After the 2003 SARS dip, the Hainan tourism trade grew steadily over the next 2 decades. HNA positioned itself to benefit from those tourists in multiple ways. Over 40% of arrivals to Hainan came on a Hainan Airlines plane. They landed at an HNA-owned airport, stayed at HNA-owned hotels, and were guided around by an HNA-owned travel agency. This diversification is not only a reflection of the company's vertical integration strategy, but also an indication of the scope of its ambitions. They were the first Chinese airline to purchase and own their own airport. Co-founder Chen Feng said, "Our dream is to turn Hainan Airlines into an international enterprise which can compete with the world giants." In 2008, the global financial crisis seemed to impede those dreams. It wrecked the world economy and caused HNA Group to fall again to a 1.73 billion RMB loss. They attempted to raise funds by IPOing their airline subsidiary, Grand Air China, on the Hong Kong stock markets. However, the difficult financial market situation in 2009 made this infeasible. The company made it through thanks to 2 big events. First, the Hainan provincial government injected another 1.5 billion RMB into the company. Second, as the crisis unfolded in November 2008, the Chinese government announced a 4 trillion RMB stimulus package. In it were new infrastructure projects that caused land prices across the country to skyrocket. This included about 9,000 acres of land in Haikou that HNA acquired when it bought Haikou's airport. The airport relocated elsewhere, but HNA held onto the land, ideally positioned in the downtown area, for many years. This land became immensely valuable. On the basis of this development, HNA sold 4 billion RMB of bonds and 2.8 billion RMB of stock, ending the company's crisis. There was one other way HNA Group recovered. By moving company assets between subsidiaries at favorable prices, HNA can generate a paper profit. Most notably in 2004 and 2005, 2 HNA subsidiaries, including Hainan Airlines, invested 600 million RMB to build their HQ Kehang building in Beijing. At the end of 2007, the subsidiaries transferred the building to HNA at cost. A year later, HNA sold a 95% stake in the building back to Hainan Airlines, the subsidiary, for about 1.7 billion RMB, recording a profit of about 1.1 billion RMB. But no big deal, right? Just a little light fraud between friends to boost operating results. Anyway, many normal companies would consider this second close call as a sign to shrink and deleverage. But HNA was no normal company. The financial crisis and the recession that followed gave HNA plenty of cheap overseas targets to look at. HNA wanted to take advantage and launched the Super X plan with the goal of accumulating 1 trillion RMB of assets in just 5 years. From late 2010 to 2017, HNA spent billions of dollars to acquire hotel brands, technology companies, urban real estate, and airports. This frenzy peaked in the 3 years from 2015 to 2017, where HNA spent $50 billion to make 123 acquisitions. These acquisitions are in wildly different industries. We can try to organize them into a few broad categories and go through them category by category. The accounting, however, is nowhere near complete or comprehensive. The first category is the travel industry, including airlines and travel groups. Some of HNA's earliest acquisitions were airlines. In 2006, HNA acquired Hong Kong Airlines and Hong Kong Express Airlines. Under their ownership, Hong Kong Airlines expanded into cargo shipping, and Hong Kong Express tried to build up a low-cost carrier model like the old Hainan Airlines did. The Hong Kong purchases gave HNA its first international routes, a major step forward. Later in 2012 came the purchase of a 48% stake in the Eagle Air airline, France's second oldest cargo airline. It mostly services North Africa, but also gave the company permission to fly into Europe, including France. Chinese regulations at the time allowed just one Chinese airline per international route, so this was probably them trying to get around that. In 2015, HNA bought minor stakes in South Africa's Comair and Brazil's Azul. Now these moves were particularly strange because none of HNA's airlines at the time flew into South Africa or Brazil. Accompanying its airline purchases was a 2015 $2.8 billion purchase of Swissport, a cargo handler, and a 2016 $1.5 billion purchase of Gate Group, a Swiss airline catering business. It makes a lot of sense that HNA Group would have a great interest in hotels. It is in line with their business model, and you can remortgage the properties. Starting in 2011, HNA started buying into NH Hotel Group, a Spanish company that was then Europe's third largest hotel group. Over time, the company raised its stake to about 29.5% with 4 board seats. The two did a joint venture to build hotels in China. The signing ceremony was reportedly attended by Premier Li Keqiang and Spain's Prime Minister Mariano Rajoy. Then, in 2016, the company bought Carlson Hotels, which owns the Radisson Hotels brand, for an unknown price. Carlson and the aforementioned NH Hotel Group are direct competitors in Europe. This conflict of interest eventually caused NH Hotel to boot HNA's 4 members off their board. This was just sloppy work on HNA's part. Why would you not run this purchase by your other hotel subsidiary? But wait, there's more. In 2016, HNA bought a 25% stake in Hilton Hotels from Blackstone. Blackstone sold the stake at a price 3 times higher than what they paid for it back in 2007. The next category of HNA empire building includes its logistics and shipping buildup. In 2008, HNA announced plans to create a global container shipping business with a fleet of 200 ships. To back this, they bought Jinhai Shipyard, a shipbuilder, and Tianjin Marine Shipping, a marine shipping company. But the most eyebrow-raising acquisition in this sector was Tianjin's $6 billion purchase of Ingram Micro. Ingram is a global IT equipment distributor with over $46 billion in revenue in 2015. However, the company made just $266 million in net income that year, which translates to a profit margin of less than 1%. From the very beginning, it was a strange purchase. In its press release, HNA explained that they wanted to deepen Ingram Micro's involvement in the China and Asia-Pacific market. 20% of Ingram's 2015 revenue was from Asia. Just 5.4% came from China, though China did account for 23.1% of the company's total profit. But why would a marine shipper buy into what I presume is one of their customers' businesses? Interestingly, this purchase fell under regulatory scrutiny by the Committee on Foreign Investment in the United States, or CFIUS. CFIUS approved the deal, one of the few such China-US technology deals to get done in the past decade. Inspired by GE Finance, HNA wanted to build up a financial sector arm, which they named HNA Finance. HNA Finance wanted to do heavy asset leasing and insurance. In 2009, the company acquired the Australian aircraft leasing company Allco. Allco lost $1.4 billion USD and collapsed into insolvency during the financial crisis. HNA bought the company out of liquidation and moved it to Hong Kong. There, they merged it into a publicly traded affiliate, Bohai Capital Holding. Bohai would be the corporate vehicle for all their heavy asset leasing efforts. In 2011, Bohai spent $1 billion, not including debt, to buy GE Seaco, the 5th largest container leasing fleet. GE Seaco buys dry freight, refrigerated and tank containers, and leases them out. Then, in 2015, Bohai bought an 80% stake in Kronos Group Limited, which they merged into Seaco to add more scale to their container leasing business. A year later, Bohai paid $7.6 billion to buy the Irish leasing company Avalon. This made HNA the fourth biggest airplane lessor. Finally, in 2017, they purchased CIT Group's aircraft leasing business for $10 billion. Morgan Stanley financed $8.5 billion of that $10 billion purchase price. Altogether, the combined company had 910 aircraft in its fleet and was the third largest such company in the industry. And then there are the purchases that do not fit into any of the above categories. A 2016 $1.1 billion purchase of the land under the former Kai Tak Airport in Hong Kong. A March 2017 purchase of a majority stake in the money-losing Frankfurt Hahn Airport in Germany, its first and only international airport acquisition. There was also a 9.9% $4 billion equity stake in Deutsche Bank, one of the world's most important financial institutions. This was built up in early 2017 through an Austrian firm and a fantastically complicated web of offshore companies. The chain is 7 companies deep. Through this web, HNA claimed itself to be Deutsche Bank's largest shareholder and managed to place a representative on the board. There was also the $2.21 billion purchase of 245 Park Avenue in New York City, which closed in May 2017. One of the biggest transactions in New York City real estate history, 1.75 of the $2.2 billion was borrowed. Just a month earlier, HNA closed on the aforementioned $10 billion Citigroup purchase and announced that they had bought a 16.8% in Dufry Group, the largest duty-free shop chain in the world. Gosh. So where did all the money for these purchases, oft made at an elevated price, come from? The vast majority of the money was borrowed, but against what? The first major debt source is land and land development. HNA shifted from relying on mortgaging out plain assets to mortgaging out land development projects and other hard assets. Across China, provincial and city governments were starting infrastructure projects, as per the guidance from the central government. For instance, in 2012, the Hainan provincial government announced that it would build a big business district. But many of these governments are quite indebted. How do they get the money? HNA partnered with these governments to do these investment projects, leasing them the assets so to help them duck their debt limits. HNA then spun these various land development projects off into publicly traded subsidiaries. The subsidiaries' net asset values, and thus stock prices, skyrocket. HNA's management can then pledge these shares to borrow even more money. This leads me into the second major funding source, a super complex capital structure. Very early on, HNA devolved from a traditional corporation that most people would be familiar with to a complex, intertwined web of China-based investment entities. Some of these are privately held, but a great deal are public, including 10 on the Shenzhen and Shanghai stock markets, and 7 on the Hong Kong markets. As HNA acquired entire companies or stakes in companies during its acquisition frenzy, even as they borrowed more and more money to acquire it, they can inject those acquisitions into their web and then remortgage them out for even more money. Though the company seems to be run and operated by its management in the core HNA Group Corporation, the stock ownership and debt ownership links are so complicated that it is hard to tell who owns what. I am kind of reminded of a Portuguese man of war. That's not a real jellyfish, but an agglomeration of smaller creatures. They band together as a clump, consuming anything in its way. The other thing about the man of war is that it is entirely dependent on the seas and currents for survival. If the waves were to suddenly push this beast onto the shores, then it would not survive for very long. In mid-May 2017, HNA issued $500 million in bonds for its 245 Park Avenue purchase. It would be one of HNA's last overseas M&A financing transactions. On June 22, 2017, the China Banking Regulatory Commission ordered several banks to conduct risk checks on the amount of overseas borrowing and investing by HNA and other conglomerates like Anbang and Dalian Wanda. Everything changed from there. In July 2017, HNA subsidiary Shareco canceled their in-process purchase of a 34.9% stake of the American in-flight entertainment company Global Eagle Entertainment. That month, it was reported that Morgan Stanley, Citigroup, and Bank of America stopped taking any more shares of HNA Group companies as pledges for new loans. Goldman Sachs followed suit a few months later in September 2017. That same month, the Hong Kong Monetary Authority requested information from HNA about its financial status. In November 2017, HNA issued $300 million of 363-day dollar bonds at an interest rate of 8.875%. The extremely high interest rate was China's highest ever rate for its class. Yields on HNA debt began to rise. Then that same month, the Chinese central government criticized one of HNA's core real estate projects, the Sanya New Airport Reclamation Project, for quote-unquote suspected illegal use of the sea. This shook confidence in the company's vaunted government connections. A few days later, in late November 2017, HNA reported its core financial data. The showstopper was HNA's estimated current loan balance of 637 billion RMB, or 94 billion USD, using 2017 exchange rates, up 36% from the previous year. If you were to include the company's unlisted subsidiaries, estimates went as high as 1 trillion RMB, or $148 billion. Yet, even these estimates fell short of the eventual actual number. This made HNA Group Asia's most indebted company. Standard & Poor's and other credit rating agencies rushed to downgrade the company's debt. January 2018 began with a series of reversals. HNA management met with its creditors. They told them the company planned to unwind its buildup and return to its core airlines business. They would sell 100 billion RMB of assets in the first half of the year. A third of HNA's publicly traded affiliates had their shares suspended. This included HNA's tourism service business, Bohai Leasing, its leasing business which had once been the third largest in the world, Tianjin Tianhai, the shipping/logistics company that owns the American IT distributor Ingram Micro, Hainan Airlines Holdings, which held the company's original airline businesses as well as the others it created over the years, and CCOP Group, which owns and runs a large chain of retailers like supermarkets and department stores in northern and central China. For some of these companies, HNA had pledged up to 60% of the total share circulation for loans. This had been one of the company's key sources of cash, keeping the whole group together. Throughout 2018, HNA began the process of selling off the various assets that it purchased only a year earlier. This rapid sell-down took place in the midst of great personal tragedy. In July 2018, Wang Jian, one of HNA's co-founders and the inside man said to be running the company's day-to-day operations, fell to his death in a tourist area of France. He had climbed a wall so that his family can get a photograph of him and then accidentally fell about 15 meters. There are some dubious reports that he deliberately jumped off the wall, but the French authorities don't seem to believe that. Wang's 15% stake passed to the American nonprofit that now controlled the majority of HNA's shares. Chen Feng's son, Chen Xiaofeng, was appointed the new deputy CEO, and the asset sales continued. Slowly, the assets melted away. 2 plots from the Kai Tak airport site in Hong Kong were sold to Henderson Land for $2 billion, a rare recorded gain. A bit of the stake in Deutsche Bank sold off in 2019. They are still selling it down today. Swissport was swapped away to its senior creditors in August 2020, and the massive Ingram Micro IT subsidiary was sold to Platinum Equity in the December 2020 sale. It seemed like the company might actually make it through, but the devastating effects that COVID had on HNA's core airline and travel businesses sparked a final crisis that the company could not overcome. And thus, on February 2021, HNA finally entered bankruptcy proceedings. When the filing came in, the company had acknowledged $170 billion of debts from creditors. The company will likely be split into 4 businesses after all the bankruptcy procedures are done. And as for Chen Feng, on September 2021, he and his chief executive Adam Tan were detained by the Chinese government for suspected crimes. In a 2012 investor presentation reported by the Financial Times, a banker tried to reassure potential investors with the following line: To outsiders, this seems opaque and confusing, but investors should take comfort from close government relationships at many levels, both above and within the HNA umbrella. What held together the whole enterprise were mountains of debt and the unspoken implication of close government involvement. The notion floated around that HNA can only have gotten so far, borrowed so much and bought so much, because it had the backing of, or was even a vehicle for, the Chinese government. This caused a lot of anxiety for people in the West. Was it real? Who knows for sure. Perhaps on some level, HNA and its fellow conglomerates did have that approval. People have made those claims. But one can make an equally strong argument that the company's incredibly complex structure existed for a reason, and that was to dodge oversight. At least until it no longer could. Alright everyone, that's it for tonight. Thanks for watching. My thanks to my intern researcher Adam Kim for his work on this. Subscribe to the channel, sign up for the newsletter, and I'll see you guys next time.